Okay, so welcome everyone. Another lovely Saturday. Thank you for joining again. A little bit of different tune this week. I think usually, well, I always try and be very positive and bullish and go back to the data on just about everything in a lot of these sessions. But as there's a chat here, somebody mentioned that there's always an emotional side to the market that I think a lot of people ignore. And maybe for those new to the markets, and I'm not saying I've been in here forever either, but since 2013 kind of saw a little bit of the euphoria and then the collapse and the denial and kind of what happened through that. So we have to always understand there's an emotional side to the market that may not make sense in the short term and can lead to pretty significant losses. I think a lot of us in the oil industry, in the oil investments, our portfolio level is maybe an order of magnitude bigger than it was in 2020 or even in 2021. So as the numbers get bigger, the percentage means that much more. And I don't think I need to explain that, but as the numbers just get bigger, the personal vested emotions and kind of mental fortitude get bigger. So I thought I'd bring it back to the basics here a little bit. I've had a few people message me that they don't even really understand the different plays. They're buying XYZ company and they don't know where it is within Canada or within the US. They don't really understand the pipeline infrastructure. There's a lot of talk about crack spreads, and people are like, well, we don't even know what refineries do. So, or where they are, or how the oil gets there, how the oil is sold. So thought I'd kind of bring it down to this. So a couple of things before I get started. Again, for anyone on the Twitter call that would like to join for the Zoom, whitetundra.ca, scroll to the bottom under events, there is the Zoom link. I can only take questions on the Zoom just because the audio recording screws up otherwise. I also want to say I'm not an investment advisor. Everything I share today is just my information, what I use, my opinion, stuff I found online, and put my interpretation on it. So please, even though we're not talking about investments specifically, please do your own due diligence, check your risk tolerance, your kind of portfolio construction, especially. I cannot stress this enough. Even in bullish markets, people find ways to blow up accounts and lose money. And right now we can maybe say we're in a broad-based bear market, which just extremely tough to trade these, to invest in these. So yeah, please have a very clear look at your risk tolerance and what allows you to still sleep at night. I'm a big proponent of this. I've seen people go through a lot of things, even when they're making money or losing money, etc. But anyway, I'm rambling here. The recording of both the Zoom and the Twitter space will be posted. The Twitter space obviously on Twitter, the Zoom link on the website. For anyone that's kind of new to these, I've done some valuation sessions in the past, some macro outlooks that are way more in detail as to the market specifically. So, if you like this, you're more interested in more of the valuation models or the company specific stuff or the macro outlook, please definitely have a look at that. But yeah, other than that, we'll get started here. I do have a mailing list that I use to send out the invites to this and the files. So if anyone is interested in that, please message me. We can get you on there and kind of give you a heads up on some of these things coming up. And I also want to say one thing, that tomorrow I was going to have an option seminar, 11 o'clock Mountain Time, but I've got quite a few requests here about people who are maybe looking to get more conviction in the trade. They want to know what sort of data I actually look at on a day-to-day, week-to-week basis. So tomorrow, 11 o'clock Mountain Time in the morning, I'm going to do a quick little session about the main free sources of data I look at, some of the other sources that are, you can get them for free, but people don't know where to find these sorts of data. Some of the more nuanced inventory, supply, demand, travel, etc. data. So I'm just going to share that tomorrow, and maybe people who want to do their own work on following stuff day to day. I know some people, you've got summer plans, you've got families and kids and other stuff, and you're busy with that. So feel free to ignore that. But there's quite a few people who are like to nerd out on the data, if you will, like I do. And you know, I'm doing less and less of these macro sessions because it's just 4.5 hours, 5 hours long. You know, there's no point doing them every month. So people who want updates, this will be a way for them to kind of follow along as they go. And just interesting data points that pop up, you know, that are totally against what people tell you. For, you know, for example, the American TSA number of people flying data is up so much in the last week to 10 days. Nobody's really talking about it, how even within America, people are traveling at an extreme rate, way more than they were 2 weeks ago. And all I hear about is recession and people are going to collapse and all this. So sometimes it's good to get back to the data and look at what the numbers are. And yeah, all my sessions are recorded. But anyway, I'll get started here. So intro to North American oil markets. I just want to talk about the different production basins, how much they produce, kind of what they are, so people have a better idea of kind of the companies involved, where they're drilling, where they operate. A little bit about pricing benchmarks, where pricing is set. I'll explain how oil got to -37, you know, last year, how it can get to X amount of dollars per barrel this year. I'll talk about some of the refining infrastructure, as the refining is the bottleneck these days. I want to talk about just a little bit on the pipelines and the future pipelines that are coming online, and just some other basic stuff about oil that I think I just want to share and get feedback on. I think this is the first iteration of this sort of session, and as we kind of build it out, I'm happy to take suggestions on how it can be improved and you know, more data, less data, et cetera. So please feel free to message me or give comments. So the first thing I want to start with, and probably the most important thing today, is world oil demand. There's all this narrative out there that world oil demand is going to collapse. We're having a global systemic recession. The people in emerging markets can't afford this. We're having demand destruction. And frequently what you'll find is that there's no data supporting any of it. People will just throw buzzwords out there. The media will just throw buzzwords out there that, you know, society is going to collapse and people are going to die and everything's going to go to zero, you know, blah, blah, blah. And they never have any data to show you anything that supports their claim. So here's the data. Here's the early 2000s recession in the US. Here is what we can maybe say the global, you know, to some extent, a global recession in 08, 07, 08. We saw a lot of countries suffer, including the US big time, Great Recession, as they call it. So what do I see in this chart? I see that you have these temporary blips, possibly. They're not very big. They're no means 5, 7, 10 million barrels a day, enough to, you know, bring crude down on its knees, especially as we sit at multi-decade low inventories. But the most important point I see here is that after the recession, it's not that the crude oil demand goes back on the lower line. It actually rebounds with what I call this pent up / somebody called this deferred demand, where we actually come back to this original trend line despite the short-term loss. And why I think this is important is because people forget that COVID was a recession. In the US, technically we did go into a recession. So did many other countries. We lost oil demand, not just 1 or 2 or 3 million barrels a day. We lost 7 to 8 to 10 million barrels a day for a very short period of time, upwards of 3 to 5 million barrels a day for the whole year. I don't know the exact number. It's not really relevant. The point is, we're going to go back on this line, not the bottom line where we ended up in COVID. So anyone comparing demand numbers that, oh, we're at pre-COVID demand, what does it really mean? It doesn't mean anything. Why are you comparing everything to pre-COVID demand? It's been just about 2.5 years now since COVID first kind of came and affected oil demand. So 2.5 years later, we should now be 3 million barrels above pre-COVID demand on a stabilized basis. And you add to that the pent-up demand, which is the people who haven't traveled for 1, 2, 3 years. This is not something that happened in a recession. People still had the flexibility and the freedom to rack up debt and go wherever they wanted, to still go camping, to do whatever they want. That has not been the case for pretty much the first time in history. So what is world oil demand going to get to here in the next 6 months to 1 year? If you're going to claim that there's demand destruction of 3 million barrels a day, okay, so let's say the stabilized demand today should be 3 million above pre-COVID, just based on worldwide demand trends. We add in another million barrels of pent-up demand, so we should be at 4 million barrels a day above pre-COVID. You take 3 million barrels a day of your proposed demand destruction on top of that, we actually end up still consuming more than we were pre-COVID in a worldwide recession. This is a point I really want to get across, something that people completely misunderstand. They think oil demand is going to fall back to 95, 93 million barrels a day. It's not going to happen. It would take a systemic collapse of major proportions for something like this to happen. So again, I just want to get that point across. Where are you taking your demand destruction number from? If you're taking that and subtracting that from pre-COVID demand, completely wrong. In my opinion, that's a completely wrong way to look at it, because that's just not how history has been. This chart, I can show you a 40, 50, 60-year chart. It will look the exact same. We had China being the big factor since 2000 onwards, and the price is going up from a $25 a barrel in 2000 to a sustained, $60, $70, $80 range. These are our big growth wedges now. Brazil, South America, Southeast Asia, India, some of the Middle Eastern countries are now going to be in this sort of growth cycle that you saw China here taking up market share going forward. So there's a question here. I don't have this graph to 2022, but basically, if we look at where we were in 2017, we were at roughly 96 million barrels a day of demand. 2019, we were almost at 100 million barrels a day. So we were growing at that annualized 1 to 2% range, depending on which number you want to use. This is not an exact science. There's a lot of guesswork associated with this, but the overall trend is correct. For anyone looking to know more about this specifically, check out Mike Rothman's work on why he believes the world has underestimated demand for basically history, because they just don't have a good understanding in some of these emerging markets and small countries of demand. So I wouldn't be surprised if demand is actually higher than this, and it's just being consumed internally with no one knowing about it. So I want to get that point across. We look at oil production. If we're consuming roughly 100 million barrels a day, we're producing roughly 100 million barrels a day. That's what keeps the market in check. So some of the biggest contributors, we see the US had its conventional production in the past in the 1950s, 60s, 70s. They were at 8 to 10 million barrels a day. Their conventional production started dropping. And then we had the shale boom, which brought them back to this roughly 12 million barrels a day today. We have Russia. Again, people forget that Russia had a massive growth cycle in the 1990s to pretty much just about double production. And that's another point I want to make. Again, I know I'm going kind of off topic here, but it took a lot of countries putting a lot of money into oil in order to keep prices relatively flat, or even to not grow at this extreme pace. And people just forget that. They take that for granted that, when the oil price gets higher, we'll just produce another 10 million barrels a day in the next 5 years. Well, where is it coming from, this cycle? Can anyone point to a country that can grow 10 million barrels a day in the next 5, 7 years? Hard to find. And we see these same growth cycles, whether it was Russia in the 90s, whether it was the States since 2008, we see Canada, Iraq growing by 2 to 3 million barrels a day each in about a 10-year period, 10 to 15-year period. So these are the 5 biggest countries today, producers. We have Saudi Arabia, which has kind of been the stalwart for multi-decades now. being the leader of OPEC. We have Canada and Iraq making more and more of a share, and possibly two countries that people would look at if they wanted to increase their heavy oil, low decline production going forward. The point I want to kind of also get across here is that 5 countries control roughly 40% of global oil supply, 40 to 45%. So it's a very concentrated market. There's only a few countries that really know how to produce oil, that have the expertise to produce oil, and that really have the equipment and the geology to begin with to produce these massive quantities, which not many countries are able to get to, 2, 3, 4 million barrels a day of production. So the American consumption by product, America consumes roughly 18 to 20 million barrels a day every single day. So just visualize that. You've all seen oil barrels. Just America consumes 20 million of those every single day. So perspective, anyone telling you that oil is dead, that they're getting off oil, has not done this thought exercise. 20 million of those worldwide, we use 100 million of those every single day. Every time we use them, it's gone. You cannot recover oil after using it. We only have so much oil in the ground. So again, this is not an infinite pool sitting there waiting to be extracted. This is a highly capital intensive industry that uses 100 million barrels of oil a day. So on the North American oil markets, what are we selling? 44% is gasoline, 21% is diesel. We have hydrocarbon gas liquids, which often get ignored in the demand numbers. And we have jet fuel, aviation, and other. So again, when you're looking at North American oil markets, you want to focus on the products. What are people actually consuming? Motor gasoline, distillate. These NGLs, propanes, and butanes have gone to be a bigger factor more and more, especially in the industrial side. So some of the businesses, some of the equipment, factories and such, they're using more and more of these products. And for anyone looking at kind of oil demand, you want to have a look at all of these. You can't just say, oh, in a recession, this is going to fall or that's going to fall. Where exactly are you going to see demand destruction or recession, etc.? So the pricing benchmarks, where is crude priced at? We have, I don't know if you can see this, we have WTI price on the top, which is your West Texas Intermediate price, probably the most well-known pricing benchmark out there. It's in Cushing, Oklahoma. That's where the WTI price is traded. We have Brent crude, which would be our North Sea UK oil. A more important benchmark in the past, less and less important as we go, just because of declining North Sea production. The WTI benchmark has become more of the focus around the world. And we have a lot of other crudes out there that people often ignore. Just give me a sec here. We have some hijackers here, so I'm just going to stop the chat here for a bit. So we have other crudes also that people often ignore. That it's not just WTI that we sell oil at. It's not just Brent. Every country has their own pricing benchmarks. We have Murban crude, which I don't exactly know where this is. I think Saudi Arabia, somewhere in the Middle East. We have the Mars US. So Shell's Mars platform, which is offshore Gulf of Mexico, actually they get their own pricing. They don't really price off WTI, and they have their own pricing. We have Louisiana Light. We have some of the Bakken grades. We have some of the grades out of the Eagle Ford. We have the Mexican basket, the Canadian crude index. All these prices are different. And to bring this back to investments, when you're looking at companies, there's been companies that have had huge changes in their pricing in the last, call it 2, 3, 4 years. For example, Enerplus in the Bakken used to get $4, $5, $6 below WTI. Now they get $1 or $2 or $3 above WTI. Keep an eye on where exactly your company is selling their crude and at what pricing benchmark they're selling the crude. It's very important. It can make a material difference, especially when the certain areas of the market get dislocated. You have pipeline issues, you have refinery issues, and certain areas okay. Yeah, and sorry, I'm just having issues with the chat here. Give me 1 second. Okay. Okay. Yeah. So just keep an eye out on where you're selling the oil, what price you're getting. That's the point I want to make. If we look at the Russian barrels, it's obvious what's happening here. The Russian so-called grade is selling at $105, but the ESPO grade, along with some of their other major grades, are selling at $30, $35 below WTI. So, you know, when people talk about the fact that oil prices, Russia is selling them cheaper, this is what they mean. They sell the oil at different benchmarks, which are sold at pricing that the traders are trying to get the highest price, make the most money, and kind of go from there. So there is a question I missed here. Yeah, so John, I will get back to you with the 2022 crude oil demand number. And if you just search up crude oil demand, I think the first link on Google shows that. I just didn't want to put in a graph that has this massive draw because it doesn't get the point across, and it dislocates the 2008 recession and showing that in detail. And just a fun fact, the Tapis grade in Malaysia is probably one of the most expensive grades out there. So, you know, if somebody asks you, well, you know, what's the different grades out there? There can be a huge difference in pricing, even if we ignore the Russian barrels. You know, Canadian crude selling at $15 below WTI, Tapis grade sells often at $10, $15 above WTI. So there's a huge difference there, even in regular times with no war, no conflict, nothing. And it can make a big difference to the cash flows at the end of the day. So, okay. How much percentage of inflation is tied up to Russia-Ukraine war, resulting into high oil prices? I don't know the macro of that well, but I will say that I do think inflation is tied to higher oil prices. A lot of it has to do with energy, and you're not going to tame that by doing all this other stuff until you reduce the demand for oil. And as I just mentioned, this is why I spent so much time on it, is that oil demand is a completely misunderstood number. So the impact on inflation, again, is misunderstood. I don't want to go into the weeds, but I'm happy to discuss this exactly and my thoughts on this in the Q&A session or on a Spaces afterwards. So any particular reason the prices are in USD for all blends? Yeah, that's the answer. All commodity trades in USD. It's priced in USD. Even if the actual trades don't happen in US dollars, I think they're all priced and bid up in USD. When the big commodity traders go out and they look for bid and asks, I think it's all in USD, but don't quote me on that. This is just the way that it's shown here. Okay, so Cushing, this is Cushing, Oklahoma. This is where your WTI price is set. This is where people figure out what's going on. It used to be kind of a bigger storage hub. With the increase in production in the Permian and kind of all across Texas, it's become more of a transitory area where oil comes and goes. It's not really a big storage hub. But the point being that this is where the oil is physically traded. Now, not all volumes actually are traded here, but the contract trades here. And I guess for those who are new to the sector, to explain why oil went negative in 2020 is basically what happened is all the tanks started getting full. There was no storage space. People had contracts to take delivery, physical delivery of the oil at Cushing, and they had no tank space to store it. So if you don't have any tank space, what are you going to do with 500,000 barrels of oil that suddenly shows up, and you got to do something with it? You can't just put it in the river or truck it out. So what you will do is you will just instead give up the contract. You'd rather pay somebody to take the contract. And again, this is a very informal session, so I want to get some of the more basic points across. But the way somebody explained this to me was that if you were in high school and you're trying to throw a huge party, and you were able to get drinks and all this and whatnot, and then your parents were leaving for the weekend, they were going out on some sort of trip, and then you find out that they canceled their trip, and everyone in the neighborhood was trying to have the same house party this weekend. Well, nobody wants to take these drinks now from you, so you'd rather pay somebody to just take them off your hands so your parents don't find out. And I just thought about that analogy in terms of oil. Is you had all this oil, nowhere to put it, no one to consume it, nothing you can do with it. So oil went negative, where people were paying other people to find ways to get rid of this oil, and put it wherever. So a little bit of a side topic there. So what's going on here? Do you think that there's a situation where we have reached peak globalization? No. So this is again one of the things that I think people get completely wrong. They think that because they focus on Europe and Japan and North America, because that's where they live or that's where they travel, they think, oh, oil demand is basically peaked here. We've peak globalized. And maybe I misunderstood this question here. But the developing world is still developing. India is still building 15,000 kilometers of highway every year. They're still building 15 to 20 airports every year. So are a lot of the other areas. And the media doesn't focus on it. We're not exposed to these growing trends. If we don't live there, we don't see it happen in real time. But the demand for oil is going to continue to go higher. And, that's just the way it's always has been. There's been many people saying oil is dead in the 70s, in the 90s, in the 2000s, the big talk about peak oil and all this, and none of it's really come to fruition so far. People love calling tops, people love calling bottoms, people love to be correct and right and virtue signal and victory lap, and at the end of the day, the market and the data humbles every single one of them. So it's important to kind of take things in perspective on that. And your second question here about different grades could develop into much larger spreads. Yeah, possibly. With the world kind of going into two separate power spheres of influence, we could see different dislocations in different spreads across kind of where things are. So yeah, great question on that. So let's look at the Canadian blends. And I think, again, people only focus on WCS, the Western Canadian Select, which is traded at Hardisty. That's all people really know, but we have many, many, many blends in Canada. We have the Midale, Saskatchewan. We have the Albion Heavy out of the Shell fields in the oil sands. We have the Clearbrook, which is more of a Bakken grade, Manitoba-ish. We have the Syncrude Premium, Peace Rivers, Central Alberta. They all trade at different pricing. And what's funny is that Canada has such a concentration in their oil production that a lot of companies have their own grades. So we see Syncrude, we see the Albion, Meg Energy sells their oil at their own grade. No one else has that grade of oil. So just keep these things in mind. $5, $6, $7 may not sound like much, but it makes a huge impact to cash flow on your favorite XYZ oil company. Quickly on natural gas, we kind of have the same thing in natural gas. People only know AECO and Henry Hub. That's all they seem to talk about. Well, look at your favorite gas producer. Look at ARC Resources, look at Tourmaline, CNRL. They have contracts to sell gas, natural gas into Malin in Washington State, to Southern California, to Chicago City Gate, uh, of course, Henry Hub, New England. All these hubs get different pricing. Tourmaline in 2020 made a ton of money. So did Painted Pony by selling gas into this Malin terminal because there was some sort of pipeline explosion. So the gas was selling for 3, 4, 5 times the price. Companies selling natural gas into Southern California are getting $3, $4, $5 above what you see for your Henry Hub pricing on your screen at certain times. These things are stuff that is not often factored into cash flow, but is why you'll see a lot of companies will report their realized price for gas. It ends up being 20, 30, 40% higher than the benchmark. And you're wondering why that is. Can it keep going on? It's because they're selling gas at different hubs, they're not selling them at ACO or at Henry Hub. Again, something that's going to become more and more important as the bull market kind of progresses. If natural gas is trading at $12 an MCF and your favorite company is getting 30% premium, that's almost $4 extra per MCF that needs to be factored into cash flow calculations kind of going forward. So again, I know I've been talking a lot on this, but it is very important to look at the exact benchmark, where oil is sold, etc. This is Hardisty, Alberta. This is where your Western Canadian Select benchmark trades at. Beautiful place. I've driven through many times. Yeah, just to visualize what we're seeing here, I think Hardisty is roughly 40 to 50 million barrels of storage. Cushing is 90, 91 to 100 million, somewhere in there. Big tanks, they're floating roof tanks. So as the level of oil comes down or goes higher, the roof actually will move to reflect that. And one of the ways that we get oil inventory data through satellites tracking the levels of these floating roofs. So another kind of interesting tidbit, I guess. Oil wells. Oil wells are everywhere. This is Calgary right here, for those of us joining from the oil city. Oil wells are literally everywhere. They're all around you. There's no reason to be scared of them. There's no reason to, think they're this evil thing that we don't want anywhere near us. We don't want them in our backyards, the whole NIMBY thing. They're already around you. Yeah, they may not be exactly in your backyard, but you drive 10, 15 minutes and you can find many, many, many oil wells. These are the new horizontals. These are old suspended vertical wells, whether they're water wells or oil wells. It depends on the symbol exactly. But when we talk about North American oil has been part of North America, Canada, the USA for a long, long, long time. A lot of our history revolves around oil, the growth, the ability for these countries to become world superpowers, to have a huge military revolves around oil, and having cheap access to oil, having cheap access to energy, or access to cheap energy, I should say. Oil wells are all around you. So, if you're interested more, like go out, drive 15, 20 minutes, drive to a lease site, check it out, take pictures. I don't think I would recommend going on the site specifically, but some of them are right on the side of the highway and on the side of gravel roads, and watch the pump jack go up and down. And some of you may not be as interested as I am about these things, but to learn more about kind of what's going on, you don't have to go very far. But the point I'm trying to make is that oil is ingrained in the history and the growth and the capitalism of North America. And I don't think we should ignore that fact. I think it's important to kind of take that as it is and give it the benefit of what it's done for us. Okay. So a couple questions here. Yeah, so about the crack spreads, I do think as refining capacity comes online, the crack spreads are going to narrow, and especially with Chinese capacity and product exports coming online. And it will reflect in a higher price of oil, because if refineries are running flat out, they are the buyer of oil. And as long as they keep buying oil, there's going to be no lack of bid for the price of crude itself. And crack spreads don't have to stay at $40 or $50. Even at 25 or 30, that's way better than what refiners have been getting for the majority of the decade. Even if they're $20 or $22, they will still continue to run probably flat out and make money. So do you worry about prices in North America? Yeah, like I don't really want to talk about an oil export ban until something is a little more clear. I don't think it's going to happen, because an oil export ban or a fuel export ban out of the US would absolutely destroy Europe. It would destroy Latin America. So Americans would get $1 cheaper gasoline, but people would start dying in Europe and Latin America. Is that something that the American administration is going to do? I highly doubt it. I have certain views about politicians, but they still understand the difference between an angry population and a dead population. So just keep that in mind. China hasn't exported products in years. Yeah, you're right, but they're down about 200,000 barrels a day of gasoline and distillate just in the last like 6 months or 9 months. So, or a year or so. So even if they get back to that, it's going to cool the market quite a bit, because the refining capacity is very tight, but you add in 1 million or 2 of refining capacity and everything kind of fixes itself as it goes on. So we don't need that much extra refining capacity to come online. And there's other refineries coming online in 2022 and 2023 that, again, no one really talks about them, but Calvin, I think it's Calvin Froge of Twitter, does really good work. I believe it's his account with tracking refineries and the new ones coming online. So a little bit more on US shale plays specifically now. So in the US, we have all kinds of oil plays. Look at this map. Oil is literally everywhere in North America. It's not in one random part of Texas that they're making all the money off it. There's oil everywhere and gas everywhere. It's just economic at different price levels. It's easier to produce oil out of certain areas. Politically and socially, it's easier to produce oil in certain formations or certain areas. That's why we have more oil production in Texas and Oklahoma, and some of the eastern states. Pennsylvania has a lot of gas production. We have New Mexico, Wyoming, et cetera, et cetera. So the big ones we want to focus on, the Permian right here. The Permian Basin in Texas and New Mexico, the Eagle Ford, the Bakken. We have the Marcellus Shale, the Haynesville Shales, which are more of a gas plays. We have areas like the Powder River Basin, which Vermilion is active in. We have places like the California oil fields, which is a lot of Chevron. We have the Barnett Shale, and then other stuff. You have the Anadarko, which is another oil kind of play. The Canna Woodford, Scoop Stack in Oklahoma. There's many more plays than the ones we just hear about, and a lot of these companies are in many of these plays. We have Crescent Point in the Bakken and the Williston. The Niobrara was kind of a smaller field that had a huge growth cycle, and then it just kind of died. So yeah, these are some maps. I love just going into them, looking up the basin. I'll Google it and try and find which companies are active there, just check it out, see what's going on. People don't realize California makes, I believe, 400,000 barrels of oil every day, completely ignored, and no one has an eye on it. So what are the questions here? So we have, yeah, would be cool to see this North American map with all the oil names mapped out. Yeah, I think if I don't think I'll have the time to do this, but if someone has the time, look up each of these plays and make a little list of which are the top producers in those plays, or find your top oil company investment and try and find which of these plays are in, where they are. Just better understanding of what's going on within these investments. So again, the main plays are the US tracts. We have the Bakken, the Niobrara, Anadarko, Permian, Haynesville, Eagle Ford, and Appalachia. So when the EIA, the U.S. Energy Information Administration, puts out information on the EIA 914s, which is monthly production, the EIA DPR, which is the drilling productivity report, these are the plays they're tracking, because in their opinion, these are the ones that are really gonna be kind of the growth plays, or the ones to track kind of going forward. So again, the EIA does not focus on all the plays. They only have certain plays because there's just so many of them, and it doesn't make sense to track every single one all day long. You will see though, for people that track Baker Hughes data, that if I just go back here a slide, if you track the Baker Hughes data, the weekly rig counts, you will notice some of these names on there, the Woodfords, the California stuff, the Powder River Basin, you know, etc. So you might be more familiar with these names and how many rigs are running in these basins. A quick point on shale break-evens. I know we talked about this in the Twitter space yesterday. This is just operating break-even, so please know what the term means. Operating break-even, not full cycle break-even, not corporation break-even. It's your operating break-even. And look at the different plays and how different they are. You know, if we take these for fact, which I have different opinions on that, but you know, let's look at the Delaware Basin, which has been the biggest growth factor for US production in the last 2 years. Look at where the operating cost is, the operating break-even is compared to, let's say, the Powder River Basin or the Scoop Stack. So to put this into investment terms, these plays will get the money at $60, $70, $80 oil. These are the big plays when oil prices are tougher. These plays become more competitive as the oil markets kind of go higher, as we see more and more stability in the oil price higher. You will see some of these plays get more capital, get capitalized. So when you ask me, how am I forecasting US shale production or US production in general, you cannot just focus on the Permian, the Eagle Ford, and the Bakken. If we did not have these huge supply chain issues, these huge labor issues, I would be focusing a lot more on these basins here and looking for where the growth is coming from. Because something like a Powder River or a Scoop Stack, Oklahoma, whatever, could be growing behind the scenes, and we would not know it by looking at the EIA data or the main, you know, data that's put out there in terms of oil production. So again, as supply chain issues ease, as labor comes on the market, as we have more frac fleets, you know, is it going to take a month or 6 or 2 years? We don't know. But as they start getting added, I am very keenly watching, where are the rigs being added? Where are the frac fleets being added? If a rig or a frac fleet is being added in the Powder River Basin versus the Delaware, I know for a fact that those wells are going to be less productive than the Permian wells. I know for a fact there's not as much inventory in some of these basins. I know they're higher operating cost basins. So if the oil price dropped $20, we might see activity come down big time. So just a lot of things around the market that we really need to keep into mind. It's not just the Permian, it's not just the Bakken, it's not just the Eagle Ford. There's various stuff out there. The market moves in strange ways. People try and hide the fact that they're running rigs in random basins all over the place. Again, something to track. Scoop Stack has lesser land. I don't know the exact reasoning for these things, but basically the reason the operating break-evens might be higher is because the acreage quality is lower, the infrastructure is more expensive, the wells might produce more water, they might produce more gas, which now you got to get rid of. The gas oil ratios might be higher. You might have to pipeline it more. Various factors. I don't know the US basins that well, so I can't say why, but the difference is extreme, you know, pretty extreme here. This one makes sense at $70 oil. This one makes absolutely no sense at $70 oil. So yeah. So yeah, I'm getting lots of other questions, so I'm just going to pepper them in here as I go. But basically, the question asks that on the surge talk, the CEO indicated they have 12 years of reserves, the potential for water flood. Yes, this can materially increase the reserve life. Yes, anything that increases ultimate recovery out of your field will increase reserves as you go. But the reserve evaluators, they don't give you credit for these reserves until you've pretty much produced them. So technically, every reserve number that I see out there, I automatically assume if it's a conventional water flood, high original oil in place field, I assume it's understated, just the way that I know people calculate reserves. But thank you for that. So a little bit more on Texas oil production. We see what's happened here. It used to be all conventional oil, old stripper wells making low amounts of production, and then the Permian came. So the Permian, why do people talk about the Permian so much? Right there, example one. It is the biggest growth factor of oil production in the world over the 2010s, over that decade. It was the growth, literally, especially 2014 onwards. So, keep that in mind, but also keep in mind that the Permian is not Texas. Texas has another, 2 million barrels a day roughly of other production, including the Eagle Ford and old conventional stuff. New Mexico is completely different. New Mexico is a state that is literally the Permian. This state had no oil production before, literally no oil production before the Permian came around. And even in the Permian, they had old vertical wells, other kinds of stuff, because New Mexico is just a more economic area. Even in the Permian, New Mexico has the best acreage, the best wells, the best results, and the best money-making opportunities. Hence why you see a kind of a later stage growth, especially in recent times, when oil prices are a little bit lower. Were a little bit lower, I should say. Okay, so there's a question here on well to refinery cost. Yeah, I don't have that right now, but it's basically whatever the producer is getting, you add to that the crack spread. The crack spread is what the refinery is getting, including the profit margin. That's what ends up at the price of the pump. So what is the producer getting plus transportation, plus refining, plus taxes is what's the price of the pump. Yeah, I'll talk about this question later. Reiko, if you want to ask that at the end, please. And yeah, the Haynesville, the Appalachia, and the Marcellus are more gas-focused plays. So don't look at the oil production there, look at the gas production. If you're looking at DPR data, EIA 914 data, they're more gas-focused. So a little bit more in the Permian production by year. Exactly as the title says, this is the growth by the year. And at the end of the year, if you take all the production that came online in that year, this is what it ends up at as the years kind of go along. So why do I want to bring this graph up? Because it's something that's very important to the oil markets and oil supply. We have never had our oil supply have this sort of decline rate on it, ever. If we go to January 1st, 2020, we take that day, we take all the oil production in the Permian as of that day, it was roughly 4.2 million barrels, 4.1. Ignore any well that came online after that. In just over 2 years, this production declined by 60%. In just 2 years, that's how much decline we had. That's how much new production we had to bring online to mitigate these declines. Not a good thing for oil supply going forward. And I know I'm throwing macro things in here, but I also want to bring the basics back to why it's important to understand these basics. So 60% is gone. Not a good sign going forward. Just something to keep in mind. It's a treadmill. Shale is a treadmill. Permian oil here, I posted this chart on my Twitter feed a couple days ago. Despite 300, 400 rigs going in the Permian and frac fleets, production is flat. And for those new to the industry, this is something you really need to understand. Oil wells decline. Unlike your aluminum plant or your mining gold plant, which can continue at the same rate for 20 years with very little capital, oil wells decline. You need to continually jam in new capital to keep production flat. So when you're looking at oil supply demand, this is something that really needs to be brought into your investment thesis. So there's a couple comments here on the scoop stack, so I'll let people read that. Yeah, and about the NGL prices and whatnot. Something else about the Permian here. So a little bit more about well design. The wells are getting longer. So from 2012 to 2021, the average lateral length has gone from 4,000, I believe this is in feet, yeah, 4,000 feet to about 8,000 to 10,000 feet. The wells are getting longer. This is the era of the hydraulic fracturing, horizontal drilling era. So the wells are just getting longer and longer. They're jamming more sand into it. They're fracking them more and more with more pressure, with more force to try and retrieve more oil, literally. But the average oil production flatlined in Texas and New Mexico. Something to keep in mind for those who are invested in the sector. Again, I'll cover all this in my next macro session a little bit more in detail. But things are changing across the industry. There's technology happening. There's innovation happening. This is not just a North American oil market of the old conventional days. Things are moving fast. Things are changing. The top operators in the Permian, for those who are invested in US plays, Pioneer, Conoco, these huge jumps are due to acquisitions and mergers. So we see the big names are basically flat. Some of the private, smaller names are growing. Endeavor, one of the biggest private companies in the Permian, you see how they're growing. Again, for those interested in the macro, why is this important? Mewbourne, another big private, you see them growing because none of this gets shown in public market data. When you see news articles that Chevron is not increasing in the Permian, Pioneer and Conoco are not increasing in the Permian, you will never see these private companies go out there and show off that they're increasing production. Something to really watch for as an investor in oil and gas, looking at oil supply, watch for the private companies and what they're doing in these basins. And again, the names, I like looking at the names, who's producing where, what are they doing, where are they putting money in? Especially if you own the companies, very important to track. Share of US oil produced in the Permian. This is why it's talked about. This is why the North American oil markets focus mainly on the Permian and why the American oil markets focus mainly on the Permian. It's gone from about a 15% market share 8 years ago to a 43% market share. This is the driver of supply. This is the driver of growth. This is the driver of oil prices going forward. If the Permian cannot maintain, as you see, it's kind of flatlining here. If it cannot maintain this sort of growth, where does that put the oil supply demand going forward? Again, I don't want to go too much into the macro, but the markets are changing. It's important to keep in track. People who have not been in the oil market since 2008 or since 2014 will rarely talk about this phenomena and how things have changed in oil supply demand. A little bit more on US shale plays. There's about 50, I think it's 50 counties in the Permian. Only about 5 or 6 of them are really worth talking about. Leah, Eddy, Loving, Reeves, Midland, Martin, Howard maybe, and Upton. this is where the majority of the production is, where the majority of the drilling is. And why do I mention this? Because people thought North America was going to take over the world. The Permian is going to produce forever. It's going to produce for 40 years at 60 million barrels a day or 20 million barrels a day. It's not going to happen. Only a few of these counties are profitable. Some of these counties are not even profitable at $100 oil. We saw Apache put out their Alpine High scam, if you will, which was somewhere down here, I want to say. Maybe it was in Culberson, I can't really remember, but it's just not profitable. So keep an eye out. Which counties do your favorite shale plays have land in? If they have land all the way here and they're saying we got 200,000 acres, but it's somewhere on the fringe edges, you might want to look at that again. I've had a couple of private placements come to me and they say it's not in the Permian, but just to give an example, they will say we got 40 drilling locations, and I ask them where, and they say, oh, it's like on the fringe edge here. It might not even be in the Permian. It might be like out here, and they're trying to delineate something, and they're going to fool a lot of investors into thinking they have prime land when they have absolute junk, on the edges. So again, as an investor, keep an eye out on where the company's reserves are, where their production is, where their growth plans are. And you might find some of them, it doesn't even make sense where they're trying to grow. There might not even be pipelines here to send oil anywhere. So again, I'm going into the weeds, but watch. From an investment perspective, watch where the land is, where the asset is. Okay. There's a question here about Devon, and they have some of the best wells. Yeah, you're correct. The reason Devon has some of the best wells is because they're in the top counties, Leah, Eddy, Midland, I believe. And they have the best geology. They have the best land. They have some of the best acreage. It should lead to them outperforming. If Devon was underperforming, I would be really, really worried about their technical expertise as to what's going on. And yeah, that brings up another point. Sometimes the outperformance in your company's wells can strictly be given credit to because they just have better land and they just have better acreage. It has nothing to do with the company or the management or the engineering or their drilling company or anything like that. It just comes down to geology. And if you followed my kind of white tundra portfolio, you know that I love to invest in companies that have the best acreage. I'm taking the entire geological risk out of the equation. I'm putting less pressure on the technical teams and the execution, and I just trust that the land is what it is. Interesting. Okay, so there's a question here on, at $150 oil, what are the chances that the US finds another Permian? I would say the chance is always going to be there, but America has pretty much been drilled everywhere. People have well logs, people have core testing, people have done exploration just about every single place in America. So I don't think they're going to find another Permian. I do think the California oil fields can expand a lot, the heavier oil fields. It's almost like a mini oil sands, mini Canadian oil sands. But California is not going to let oil production grow. So I'm not too worried about that. And Rodrigo, you mentioned you're from Latin America, so I will say Colombia is what I'm really watching because the shale plays in Colombia are getting a lot of attention. I believe ExxonMobil is drilling a couple of shale wells in, I forgot the name of the region, but it's in Colombia somewhere. And if you just Google Exxon shale well Colombia, it'll come up. So just watch for that as well. Yeah. Yeah, so Eric Nuttall says that operators lost $1 trillion in the last cycle. Not quite. They lost 300 billion of cash, literally, but they lost over $1 trillion when you look at it in terms of the investment put in to grow production to this level. It was, I think, $1.1 trillion. Yep. Same thing on the Eagle Ford. Again, I don't want to go too much into this, but shale. This is your shale treadmill. Eagle Ford production. This is going to be a new graph, I think, to a lot of people, that the growth has started to come from the Eagle Ford, not the Permian, the Eagle Ford. And why is this important? Because I talked about this a little bit ago, that watch for where people start investing money as the prices go higher. They might move to other areas and start growing production in other areas. So a lot of oil fields out there. A lot of them make money at $150 oil or $120 oil. A lot of them make money that are not talked about very often. More wells making less oil. I don't know why I made this so macro focused, but first iteration, so just bear with me. A lot of wells in America and North America in general are just producing less oil. We have more wells making less oil each, translating to higher cost, translating to higher operating cost. Watch for your favorite companies. Are their operating costs going up substantially? Something to kind of watch going forward. The US and North America, again, has a huge difference in acreage quality. This is the Eagle Ford. Look at how much better their top county is compared to their 5th best county. It's almost a 4x difference in acreage quality and average oil production normalized by lateral length. So if you're a new investor into the oil markets, you're looking to invest in some companies, watch for the acreage. Again, where are they drilling? Where the assets are. Eagle Ford top operators, again, check out your companies, where their assets are. Are they in the Permian? Are they in the Eagle Ford? Where are they? If you're looking to do deeper dives into these names, you want to know where they're producing from, kind of what they're doing, where they're active. Is there pipeline capacity in the area? Is there gas processing in the area? Et cetera, et cetera. Eagle Ford share, as the Permian grew, the Eagle Ford dropped. That's just how it is. Again, the Eagle Ford counties, North America, you want to focus on county focused because the county itself has different rules. They have different regulations. They have different taxes, possibly in some ways, different labor, different infrastructure, different acreage quality. I keep coming back to this, but yeah, the markets, the North American oil production markets, it's important to focus on where exactly these companies are, especially if you're invested in growth companies. Watch for potential issues that arise as they grow in that certain area. Again, production by county, I'm not going to go too much into this. Bakken, same thing. North America is basically, if we just ignore Canada for a sec, North American oil production is mainly Permian, Eagle Ford, Bakken. Get to know these areas, who operates here, what kind of acreage is left, what kind of wells are people drilling. I get weekly reports telling me every single well drilled in the Permian and the Eagle Ford, and I think the Bakken as well. And what kind of rates are coming on at, who's drilling them, what was the laterals. Just data like this that I like to keep track of, just to keep an eye on the markets and kind of what's going on in the future. Where is growth coming from? Which companies are aggressively expanding and which companies are actually drilling better wells? So I've talked about this a lot, so I'm just going to ignore some of this. The Bakken oil stuff, the Bakken slow recovery. Again, which company are you invested in the oil markets? And what kind of acreage do they have? Look at Devon in the Bakken. Look at Marathon. Way better wells than some of the names you hear that are big in the Bakken. The Hess, the Continental, the Whiting. Check out Bakken acquisitions. Which companies are making acquisitions in the Bakken? Which companies are having to add rigs to keep production flat? You will find it's these lower quality companies, not lower quality companies, companies which have lower quality acreage are the ones that are in the news cycle about they had to buy more land, they had to spend money on this, spend money on that. Watch for your favorite company, the company that's at the top of your investment portfolio. Make sure they have good acreage. They're not wasting money on, or having to waste money on acquisitions and excess drilling, because their acreage quality is 30-40% in some cases worse than the top acreage in the area. Yeah, skip all this. Yeah, just production rates, just some of the other work I do around the markets, watching this, biggest producers, well status, on the overall market perspective, abandonments are becoming a bigger and bigger deal. Why? Because the wells are getting older. This is the inactive wells in purple here. You see how they're becoming a bigger share of the overall wells. So if somebody's looking to make money in the oil patch, you may not even have to drill wells. You could start up an abandonment company or something like that. And that's where the business cycle seems to be going in some ways. So a little bit more on the markets, US imports and exports. So the US used to only export basically products. They used to export a little bit of gasoline, a little bit of diesel. And then the Obama administration took out the export ban. So America went from being a domestic producer and a domestic consumer to now being a worldwide exporter of oil and products. They went from exporting roughly 1 million barrels a day 15 years ago to now exporting more than 8. The market has shifted substantially. Countries rely on America's exports today way more than they did 10, 15 years ago. So there's a question came up about a fuel export ban, a product ban. America cannot afford to do an export ban because people have literally grown to rely on America and North America. They have grown to basically be tied in terms of their energy usage is tied to American exports. So America's in a weird situation now. If they want to help their own consumer and go back to these days of lower gasoline prices and whatnot, the world unfortunately has now sucked on like a leech. And we all know how hard it is to get leeches off, and sometimes you start bleeding if you don't do it the right way. So watch for this dynamic as it kind of goes on. The other thing is US imports have gone way down. As production within the shale patch, within the Gulf of Mexico has kind of increased, America has become less and less of a net importer of oil. So again, shifting dynamics. North America is no longer a closed off area. North America is now selling oil, gas, LNG, products, propane, butane, gasoline, diesel, jet fuel. It's a globalized market. I would almost argue the market is getting more globalized in a way, to some extent. So shifting dynamics. Watch for these things. It's no longer America for America. It's now a different market. How does this play out going forward? It's going to affect the prices of these equities a lot. Whether America can build more export terminals, whether Canada can build pipelines to the coast. All of this is very important from a North American oil perspective. This one I find really, really interesting. Canada in 2005, I just talked about 2005 here. Canada was roughly 16% of US imports. Today, 61% of US imports. The US is more and more reliant on Canada for their crude imports. So why is there such a big talk around North America that people are aggressively making sure that Canada never gets an export pipeline? This right here is why. America needs Canadian imports. They don't want to see Energy East built. They don't want to see Trans Mountain built. They don't want to see Canada have its own export markets, because once that market gets globalized, America no longer has the control it needs or the control it's gotten used to these markets. So again, something that has changed dramatically from people who were invested, and they keep saying, oh, this is 2008, this is this cycle, it's that cycle. They keep comparing to the past. Things have changed a lot, and we need to look at things as they are now, not as they were, or kind of making your own assumptions on things. So within North America, it's almost become more of a monopoly where America, the USA, is relying on Canada for these imports. They basically shut down Saudi, Iraq, Mexican, Venezuelan imports are basically all gone. And when people talk about why heavy oil in Canada is so important and so valuable, this graph right here. The US refiners are set up to process heavy Canadian barrels. Canada is a huge part of US imports. The heavy oil is important. Worldwide, heavy oil production is declining, and there's less and less ending up in the US anyway. So just keep this in mind. Canadian basins. So our Canadian companies, the big sexy ones are the Montney, the Duvernay, the Cardium. The Montney would be our ARC Resources, our Tourmalines, Crew Energy, Spartan Delta, Pipestone. The Duvernay is your Crescent Points, your, I think Ovintiv sold out of it, but you have your Crescent Point, you have Athabasca oil is in there. We have Chevron. The Cardium would be your Whitecaps, your Vermilions, TACA, that's private. Many companies in the Cardium. I'm just blanking right now with all these things on my mind. This is kind of your heavy oil play. These are your Manival groups, which are your Sparky, kind of the Surge Energies of the world, some of the Whitecap stuff. And we have the Bakken, our Enerplus, our Whitecaps, our Southeast Saskatchewan, Surge, Saturn Oil, etc. We have the Alberta Bakken, the Viking, a lot of private players here, and a lot of small companies, more of a mature reservoir. So again, North America is filled with oil and gas. We take these things for granted. There's not many areas in the world like this where you have oil literally everywhere. You have oil and gas basically across Alberta, Saskatchewan, Manitoba, Northeast British Columbia. We just say, oh yeah, we just have these, it's great. But as North Americans, as Canadians, I think it's important to understand the fact that this is not common. We are blessed with these natural resources, and to vilify them, to degrade them, not to use them for the benefit of our own economy and the world economy, is just such a strange way that we go about it. And I'm sure a lot of people working in the oil fields agree with me. But kind of like a side point I want to make, and it's just curious stuff, like check out your favorite company. I keep saying this, keep using the same terms. When they say they're growing production in the Cardium by XYZ barrels, this is exactly where they are. And I'm going to share some maps here about these specific plays, where they are. Just go and have a look. See where they're drilling. Check out some of the maps online. And if you like nerding out on data, which I'm sure a lot of people attending this call are kind of like me in that way, check out acreage maps, check out new drilling development plans and North American, Canadian plays. A little bit more on Canadian oil supply. All the growth has been in the oil sands. The conventional and the shale oil, yeah, they've had a little bit of an impact recently. Same with offshore, but mainly Canada is now all about the oil sands. The huge 150 billion barrel, I think, reserve or oil as they call it. It's all oil sands growth, and Canada has become known as the oil sands, but there's only 4 or 5 or 6 companies that actually produce oil in the oil sands. So most of us investors on this call, you're in this onshore conventional or the shale tight oil bracket here. And again, unfortunately, Canada has just become labeled as the oil sands producers, but a lot of the companies that we invest in and make money off investing in are in this smaller bracket. So, within this bracket, some of the companies that we talk about may have a huge market share on the production within that supply segment. And again, when I'm just curious, I'll go and I'll try and narrow down. I'll try and narrow down this block here and figure out where's the supply coming from. Can they grow? Do they have the asset quality? Which are the big companies in this specific basin? Which are the big growth companies in this specific basin? Et cetera, et cetera. And just look into things and kind of what's going on. So I'll get to some of these questions. I appreciate all these questions, but I'll get to some of them after the Q&A, into the Q&A session here. We're almost done. There's like 5 more slides, I think 5 or 7 more slides. And then I'm happy to answer some of these questions. There's a great point made here. Canada can build its own infrastructure and basically supply the world. Same with North America in general. We are blessed with so much resource that we've gotten so complacent over it and just taken everything for granted. It's almost embarrassing the way things have kind of gone, losing market share, losing economic opportunities, losing opportunities to export product, export oil, export LNG, just getting delayed, caught up in political issues and over micromanagement of the industry. It's honestly embarrassing what's happened here in the last 10 to 15 years. Again, it's mostly oil sands growth. That's what this chart is saying here. NGLs, Canada with its own shale plays in the Montney and the Duvernay is going to become a bigger and bigger player in NGLs going forward, which are your propanes, your butanes, your condensates, your pentanes, ethanes. We're going to become a bigger player. Why is it important? Because the emerging markets are using these products. A lot of people in India use cooking gas. A lot of people in emerging markets use propanes and butanes and compressed natural gas and liquefied natural gas and all sorts of things for their energy needs. So Canada can not only become an exporter of oil through their Trans Mountain pipeline, let's say, or other ways through the US, Canada is also going to become a major player in the NGL markets. And for those who are following this, there are new terminals being built off the coast of BC for exporting propane and NGLs. No one talks about it. No one talks about it, but your company in the Montney XYZ company that's getting $25 a barrel for selling butane or propane into Chicago can possibly get $40, $50, $60 a barrel exporting it off the coast of BC. So changing markets, a lot of things happening behind the scenes, a lot of advantages, a lot of growth and development, a lot of ways to make money that nobody's really focused on, right? And no one really has done the deeper dives or knows how to do the deeper dives. But if there's one project, I would say, look at where the growth, the export growth is coming from in North America. What are we beginning to export? What is the arbitrage in pricing we're getting? And how does that come back to the producer? And you'll find certain names are set to benefit a lot. And no one's talking about these things when they talk about their conference calls or their corporate presentation. They don't even mention it, along with various other things I've mentioned here earlier. The Montney, this is the Montney map. Names that people are very familiar with. The yellow is Spartan Delta. They're the ones who made the map, so they have their stuff highlighted. We have XTO, uh, ExxonMobil, Whitecap, ARC, Paramount, Shell, CNRL, New Vista, Pipestone, Kelt, Advantage, Birchcliff, Ovintiv, ARC, Leucrotta. This was recently bought by Vermilion. Another Kelt up here, and Crew and Advantage and all of them are over here. No, sorry, Crew and Storm and Painted Pony and Black Swan, and then we're up here before they got bought out. So, you know, the same thing as a Permian. Know where your companies are drilling. Know where their infrastructure is, where they're selling oil to, where they're selling gas to, which hub are they getting pricing on, how much acreage do they have, right? Like if I was just looking at this map, the dark gray lines here are wells that have already been drilled, right? So when Vermilion tells me they bought Leucrotta and X amount of acres, I look at this map and I go, nice, it's pretty undrilled land. I have lots of locations here. I have lots of future growth potential here. Awesome. When somebody tells me they went and bought Birchcliff, look at Birchcliff's land area and how drilled up it is. And I'm not saying this is representative of reserves or anything like that. Just a visual check as to what's going on. Look at ARC Resources down here in the car. One of the biggest players in the Montney. Do they have enough land, or are they going to be forced to make acquisitions to keep their production going? Look at Pipestone, look at Spartan Delta. You know, again, I'm trying to make a visual point here that sometimes you don't even have to know anything about the oil industry. All you need to know is the basics to figure out which acreage is good, which acreage is bad. Yeah, so just stuff that I watch on a introduction basis when I'm just looking at, like, I already know the Montney, I already invest in companies in the Montney, but if somebody said Clearwater, right? I've never worked in the Clearwater, I don't know much about it. I would go and look at one of these maps and just who has the acreage, who has the infrastructure, where are the best wells? I'm going to target those companies right off the bat. If they produce free cash flow, if they have good net asset values, I invest in them. Simple. You know, a lot of my other valuation sessions, you know, sometimes make it seem like I really spend weeks and months looking at a certain company. And I do spend significant time, but sometimes we can just simplify it down for people who have a little bit less time. Look at the basics. Look at where their oil is. So when we look at the oil markets again, the acreage quality matters a lot. Are they producing oil and condensate? Are they producing NGLs? Are they producing gas? This is Hammerhead Resources, a private producer. And look at where their land is. It's all in the oil liquids rich window. So when I first made this PowerPoint, I wanted to find ways to bring it back to investments because we're all oil investors here. We own certain companies, or you're looking at owning certain companies. When I look at a company like this, Hammerhead private, backed by Riverstone Holdings, and I look at where their land is, why is it important to know all this stuff about the oil markets? Because there could be an announcement on Monday that XYZ company bought Hammerhead, and people are going to go crazy, just like they did with the Leucrotta acquisition, trying to bash it and trying to find issues and, oh, we want dividends instead of acquisitions and whatnot. And all the power to you. I'm not going to say what's right, what's wrong, but the company that buys Hammerhead, I am going to be very happy if that stock drops, and I will likely buy that company, whichever bought Hammerhead, because I know the asset is in this very productive, prolific Montney oil liquids rich window. So as an investor in the oil markets, it's important to know things before they happen. Once a transaction happens, everyone's going to be running over themselves trying to find information. We need to have information. We need to have conviction in the names and conviction in the trade. And the only way to have conviction is to run certain potential outcomes. What if this happens? What if they don't increase their dividend and they start buying up land? am I going to like this company? Am I not going to like this company? Having decision trees pre-made in your head, if not on Excel files or somewhere else, very important. Asset quality, very important. Across North America, asset quality is very important. The Montney stack, I've talked about this before, so I'm not going to spend too much time on it. But just because there's a well drilled in the area doesn't mean they can't drill more wells underneath. And one of the reasons that makes the Montney way better than, in my opinion, than the Permian and the Eagle Ford is we have way more stacks in this area than some of the other plays in North America. Northeast BC Montney, some of the other names I mentioned. Watch what's going on. The oil markets, again, to bring it back to investments. This is the Blueberry Claim area. Which names have land outside the Blueberry Claim area and are not subject to the permitting issues? Another big factor. One thing from my petroleum engineering background that I can share is that some of this land up here is not that good. And why do I say that? Is because it's on the end of the pipeline. When you're injecting your gas into the end of a pipeline, you're subject to the highest pressure on the pipeline. When wells produce, when oil wells and gas wells produce, everything will produce more if it's producing into something at lower pressure. Think about it. You can walk faster on land than you can in water. Why? Because the air pressure is less than the water pressure. So when you're injecting your gas into the end of a pipeline that's already pressured up, your wells are not going to be as good. They're not going to produce as much. These little things that matter that no one talks about, like the CNRL's acquisition of Painted Pony, there is one big problem with Painted Pony. They were at the end of the pipeline and their wells were still prolific. What that told me is that Painted Pony had some of the best acreage out there, and it got bought up by the people who know acreage best. And I'll leave it at that. There's people doing these sorts of analyses for many, many years, more than I have. They got targets on certain companies. And you know, when you're talking about North American markets and acquisitions, buyouts, mergers, people have been thinking about these things for decades longer than you or I have. And they have different ways of looking at these things, different factors that they look at that you and I would probably never even think of. So again, love these markets, very, very interesting things going on behind the scenes. The Duvernay, again, for people who are in the Duvernay area, Crescent Point recently bought in through Shell. Kiwatnock, I believe, bought the Ovintiv acreage. Chevron's been a big player here for a long, long time. PC, I believe, is PetroChina, I want to say. This is the XTO acreage for sale currently. So again, we're looking at the oil markets. The XTO package has been telegraphed. It's for sale pretty obviously. Who's going to buy it? Who is buying it? People throw out all kinds of random names. And I just look at this map and I go, you know what? I would put my money on Crescent Point or Paramount. And it's pretty damn obvious why. Chevron probably doesn't want more acreage. Repsol is looking to get out of Canada, you would think, in a way. Kiwatnock's already got their thing going on. Crescent Point is expanding in the Duvernay, and they have some land very close to it. And we have Paramount, which has basically adjacent land. So as you look at the oil markets within North America, we have some of the most transparent data out there in terms of supply, demand, inventories. We also have some of the most transparent data out there in terms of acreage, who holds what, well results, core maps, asset quality. It's all out there for us to see. And I think for those who are looking to get serious into oil investing, it's important to know these things, focus more on the little things, making accurate predictions as to who's going to buy land, who's acquiring, who's going to drill good wells. And I know not everyone is looking to be some sort of expert energy analyst by any means, But if you're only invested in 3 or 4 names and you're concentrated in those names in your portfolio, it doesn't hurt to know more about the assets, the acreage, and kind of what's going on. Clearwater, I don't know much about the Clearwater. Never worked in it. Like I said, it's a newer future play kind of coming up, and the asset maps are there for you. You know what's going to happen, what's going on. I think not that you can predict off this map what's going to happen, but if you run the recent transactions that have happened, so Ruble's done a few transactions, Baytex, Crestwind got bought out by Tamarack. There's been some other transactions. If you look at the acreage map, you'll find that the transaction usually happened with the company that was in the area. So just if you're interested in your names, what are they going to buy? What do you think they're targeting? A lot of companies themselves, they will never tell you this. It would be illegal. It would be insider trading for them to tip you off to deals and whatnot. But we can get a pretty good idea of what's going on if we just spend enough time on it and make some educated guesses. So my background is in production engineering. That's what I've mostly done, production operations. So I have a lot more insight into that. But I do want to talk about refining and transportation quick here. I must have had way more slides than I thought I did, but I think there's 4 or 5 more left. This is North American pipeline, midstream, and downstream in one picture. This is all you need. This is the Enbridge system here, the Enbridge mainline system. It goes into Flanagan, Patoka, Wood River. Here's Cushing, the oil terminal we saw before. Right here is Hardisty, the Canadian oil terminal where WCS is priced. Edmonton is a huge terminal. Edmonton and surrounding area, I should say, for oil transportation, oil refining even. This map is actually really nice, and I'll post a copy to this on my website or my Twitter feed. It tells you exactly which refinery is where and how much oil they process. This is your Gulf Coast, your Houston area. This is Midland, the Permian, all the production. You can see how the pipeline network has kind of expanded into the Permian area. The Eagle Ford down here, the Bakken area with some new pipelines. Enbridge Line 3 is kind of in this area here. The Keystone system that goes down to Cushing, eventually ends up at Cushing, I should say, in this area. So I don't really have any insight here, but I love playing around with this. The refining capacity of the US is about 20 million barrels a day, 18 to 20. Check out where the refineries are, where the oil can flow to. People worried about the last 10 years, we had this huge heavy oil discount because refineries would go into maintenance and turnarounds. This picture explains it in one sentence right here. Heavy oil is going to Chicago. Chicago has about 1 million barrels a day of refining capacity or more. BP Whiting, a big heavy oil processor. BP Whiting was the one that had an issue in late 2018 with some sort of thing in the refinery went wrong and they couldn't process oil. BP Whiting, if we zoom in, it's roughly 450,000 barrels a day that got backlogged. Thus, the heavy oil differential went up. It's that simple. We don't need to complicate it with all sorts of other jargon and explanations. It's that simple. So with Enbridge Line 3 coming online, with some of the increased throughput in these systems, with TMX looking to be closer and closer, there's a reason why I'm not worried about the heavy oil discount anymore. And yet people who work on Wall Street, who run huge funds, they keep talking about the Canadian heavy oil differential. It's going to blow out. It's going to blow out. I don't see how it's going to blow out because now we have access to the Gulf Coast. We have access to refineries over here in the Mississippi River through the Enbridge system. So there's less and less reliance on certain refineries, on certain pipelines, and we can make an educated case for it going forward as to what's going to happen. But people just don't put in the work. They look at Canada and they say two things. They say, oh, it's a tar sands, or oh, their oil sucks. It's going to trade at $40, $50 below WTI. That's the two arguments they have, both easily debunked. But people like making comments about things they know nothing about. It's a human nature thing, and we're never going to change it. All we can do is become more educated about these things and invest in things where the opportunity presents itself, where the market is clearly inefficient. And again, this is not investment advice. It's just things that I see for the overall North American market going forward. So just a couple comments, I guess. The big refining hub, as you see, is in the Gulf Coast here. So again, North American refining capacity, we see Alaska, Canada has some, mostly in the Gulf Coast area here, near Cushing in Oklahoma. The Chicago area is pretty heavy on refining. Along with this, I think this is like the Boston area, I want to say. So yeah, along with this one actually shows Mexican refineries too. So that's interesting. So yeah, just know where things are. Why is the East Coast of the USA having an issue with diesel shortages and gasoline shortages? Because they have no refineries. Simple as that. They don't have enough refineries to meet the population that exists there, and they don't have enough pipelines to meet the demand of the population there. You know, people know these areas here. This is New York, Chicago, Boston, New Jersey, Philadelphia, Pittsburgh, you know, big population centers. Look at how little refining and pipelines they have. Simple. Some of the most complicated things in the industry can be made simple just by visually understanding how the markets go, where the oil is produced, where it's pipelined, and where it's refined. That's it. You don't need to be an expert on pipelines or refining. You just need to know physically where they are. So a couple of questions. Will Canadian refining capacity increase over time? There was a new refinery put into place by CNRL and Alberta government 50-50 in the last couple of years, but I don't really know if there's any huge projects coming online. I don't think so. But you know, IECO here makes a really good point. You simply need to build refineries and pipelines, and North America could be a world superpower in oil, gas, LNG, propanes, you name it. They could be the superpower. The world has shifted from being a military might to being an economic might, or power, I guess I should say. It's gone from being a military power to an economic power, and there is no better way to control the world than to control energy. Where is the energy? Canada and the US. What are they doing with it? Royally screwing it up with slowdowns and regulations and overtaxing the industry and all these things that keep getting brought up. America could literally control the world again. It could be a world power just by building pipelines, infrastructure, refineries, export terminals, and growing their production. That's it. That's all it would take. But it's not going to happen, which is why we sit here investing in oil stocks, looking for higher oil pricing and making more money. But yeah, I don't want to go too much into this. I know there's other refining and pipeline experts on Twitter who can share more. So maybe I'll leave it for a future Twitter space. I just want to talk about this here. So refining capacity was growing throughout the decade in the US. It has now dropped because of issues with maintenance, with lack of refining profits, with lack of support from the governments, with just getting killed by environmental regulations. Refining capacity has gone down, which is why we talk about crack spreads going up and the people at the pump paying way more than they're used to for this price of oil, for X amount of price of oil. So again, I'm not a refining expert, but it's simple. The reason the crack spreads have blown out is because we don't have refining capacity. It doesn't get any simpler than that. And here is the same thing in data and visual form, in data visualization form. That's what it is. Why are the prices in the New York Harbor higher? Why are people paying more for diesel, paying more for gasoline? Why are they suffering from shortages? Simple. Look at where their refining capacity is. It's in this red box. Where are the people? In the blue box. The blue box, for being one of the biggest in terms of size and people, has the lowest refining capacity. It's as simple as that. We don't need to complicate these things. And I think knowing these things, understanding these things, gives you two benefits. One, you understand better what you're invested in, how the market works, how the oil markets function. And B, you're less susceptible to nonsense and BS that the politicians and the talking heads throw out about price gouging and all sorts of nonsense and just lies. It's straight up lies about what's going on, because they don't understand the industry. So for somebody who doesn't understand it, it's easy to just blame people and make up talks about price gouging and people trying to screw over the consumer and all this. And because it gets some votes, because the average person knows nothing about oil, let alone oil refining and production and transportation. And one of the big reasons I was so looking forward to giving out this course is because I'm a big proponent of getting energy ignorance out, having people understand energy runs life, energy runs the world. Without energy, we would all be dead in a week, literally. And there's so little knowledge about this sector that I like to share these things, keep them basic, and just have a base level of knowledge as to why these things are happening. You'll see this thing on Twitter that, oh, the price of oil in 2008 was X and the price of gasoline was Y. How come it's way higher now? People are price gouging. Very simply explained. The refining profits are higher because of a lack of refineries. You're taxing them more, and because of inflation. Simple. And when your friends and family, you're at the family dinner and somebody starts talking about price gouging, I want to give people a simple way to explain these things. And a lot of people might call you a liar, or that you're paid by big oil and all this. There's nothing you can do with people like that. People who don't want to understand logic, there's nothing you can do, but all we can do is try. Okay, so here are the pads again. The US looks at everything in pads, Petroleum Administration for Defense Districts. Keep in mind, when people are talking about pad 2, pad 3, there's a shortage of diesel in pad 1, the refining is in pad 3. It's not very hard to memorize this chart here and what people are talking about. Know where the production is, where the pipelines are. So a lot of the production is in pad 4 and pad 3. A lot of the refining is in pad 2 and pad 3. A lot of the consumers are in pad 5 and pad 1. So there's a disconnect there in where we produce oil and where we consume oil. Simple as that. And I know I keep saying this, we don't need to complicate things. It's as simple as that. We've built refineries and stuff in the wrong areas, possibly, just because we started building them, not where the people are, but where the oil is. And unfortunately, the consumers, they don't like doing this, living near the oil places, or they like living on the coasts, or they like living in the mountains, etc. Yeah, great point there, David. I appreciate your enthusiasm. So 2 more slides. What do refineries make? What do refineries use? Crude oil and all these components. And what do they make? Keep these things in mind. What does a barrel of oil actually produce? This is what it produces. And this is roughly how the consumption ends up being. Refineries can adjust their slates to produce different products, but there's no refinery out there that can convert 1 barrel into strictly one barrel of road oil or jet fuel. That's not how it works. It's a blend of products that comes out of a barrel, and that blend is based on the certain specific gravities of the products and the oil you're using. So, just a fact I want to throw out there. And the other thing I want to say is when refiners process oil, they always get more product than they consume. So refiners in the US used up 6.06 billion barrels in 2020. They produced 6.4 billion barrels of products. And why is that? Because when you take a barrel of oil, it has a specific density or weight to it. Some of the products we produce have a lower density or weight to it. So what ends up happening is you end up producing more volume for that specific weight of product. So we've got to separate volume from specific density of products, right? So one cube, or cube is the wrong term, 1 barrel of oil versus 1 barrel of water versus 1 barrel of just a barrel filled with like sand. They all are the same volume, but they weigh completely different. They have different weight. So this is known as refinery gains, and something that is important to keep in mind, that when the US says, or when somebody says they've got 1 million barrels of refining capacity coming online, keep in mind that that produces 1.06 or 1.08 million barrels of product. What does it mean? I don't have any example right now to give you that where this has really mattered that much, but there is going to come a time where this random fact, in your life, you will remember this random fact and you will think, wow, this actually ended up making some sort of difference, especially if you invest in oil and end up looking at refinery investments or transportation or whatever. It's something that's often ignored, that we only need 95 million barrels of refining capacity to make 102 million barrels a day of product. Very, very important in a market that moves big time based on 500,000 barrels a day of undersupply or oversupply. And finally, Canadian pipeline development. The Line 3 replacement has been done. The Keystone XL gone, permanently canceled, and the TMX currently in progress. It's going to add roughly 600,000 barrels a day of export capacity off the coast of BC in Kitimat, or sorry, not Kitimat, but just off the coast of BC. So future pipelines that are very important to Canadians. The Line 3 replacement made a huge impact. If you go on my website, I wrote an article about the takeaway capacity in Canada today. As in the takeaway capacity today, the article was written in February. It explains why we will pretty much never see a $25 to $30 differential again, ever in our lifetime, assuming Canadian production, doesn't go through the roof. But as we sit today here investing in these companies, anyone who tells me about a huge WCS differential blowout, I just automatically assume they don't understand the market that's happened since the Line 3 replacement came online. And as TMX gets closer and closer. So yeah, if you're interested in more about that, please check out the article. It's on the homepage. If you scroll to the files, it's or not the files, it's under the article section. You can have a look. But yeah, again, my background is more in production, so I like talking about oil and plays and basins and decline rates and all this. And I'm learning more about refining and transportation and pipelines kind of as I go. So I hope to share more and more as I go. But yeah, I'm fascinated by oil and the markets. It's a $10 trillion market that people are kind of just ignore. They think, oh, the gas pump will just have gasoline. I'm going to drive my car, and there's nothing more I need to know about it. I honestly don't think that's the case, because the oil market, it doesn't take much to have a basic understanding of it. Now, when we get into complex stuff, it gets really, really complex and can get really in depth. But the basic stuff like this, where is oil produced? Where is it refined? how does the refining work? How does the production work? What are the big basins? It's pretty easy to know this stuff, and just keep an eye on things. So yeah, I guess I can go through some of the questions now, and then I do want to wrap this up here, kind of on the hour if possible, to try and keep it a little bit short. But okay, so more consumption in Africa guaranteed. Yep. So as the emerging markets grow, North America becomes less and less a percentage of total oil consumption. And if we look forward to that market, what should North America be doing? We should be exporting our products. We should be growing production and building export terminals to get this market share. And we're kind of doing it, but not in a really aggressive way, which again is why the oil bull market makes so much more sense, because people just aren't putting the money into where we need to put the money into. Okay, so where should we look to figure out what price companies get for their oil? So this is something that's not easy to answer. It's more on geography. So for example, I'm going to focus on Surge Energy. It's my biggest holding. They produce oil in Southeast Saskatchewan. I would assume that they're selling into either the Clearwater Bakken hub, or they're selling into some sort of Southeast Saskatchewan Cromer light oil hub, Manitoba, somewhere in there. And I just make a guess. If there's somebody in the Montney, you can assume they're selling condensate at the condensate pricing. With the Meg Energy, they're selling at their own Access Western Blend pricing. A lot of oil sands, they sell at Western Canadian Select. Producers in the Cardium are probably selling, I'm forgetting the name of the hub there now, but it's a Central Alberta or something, the hub is called. They're selling it into that. For gas, for natural gas, the companies actually tell you, we're selling 9% to Chicago, we're selling 14% to Mullen, we're selling 44% to ACO. All companies have this, whether it's Crew, Tourmaline, ARC, all companies will tell you exactly where they're selling their gas. And they also tell you how that's going to change. So some companies will tell you 2022, 2023, 24, 25, depending on what contracts they have. And if you're really curious, just ask them. Email management, email investor relations, and ask them, what hub are you pricing your oil at? And tell me what percentage. And most of them will tell you, because it's not really material knowledge anyway. And they probably have never got that question. So I think they wouldn't mind sharing something like that. Okay, so sorry, may have missed it, but you mentioned the Blueberry Nations. Yeah, so anything in the Blueberry Nations map within the zone that I showed, they cannot get new permits right now. There are some permits that are making it out for new drilling, but a lot of the growth has been stunted because companies aren't able to develop their land like they want to at the pace they want to. I don't have much more to add, unfortunately, on it, because I don't know the issue in particular, but it has something to do with the fact that the BC government or the BC regulator, British Columbia regulator, had not said no to any permit for any development. So when you're a regulator, you would assume that there's an X percentage of success to getting your permit approved for development. And the First Nations found out that they literally had not said no to any permit, which makes you think, are they even checking these permits, or are they just approving everything because it's economically, the regulator gets money and the BC government gets money, they were just approving everything. So it's currently in some sort of lawsuit stage or discussion stage. I don't know exactly. I think I would leave it to the others to expand on that. But that's the gist of it anyway. Okay, so the next question we have here is, please run through the different refined products in the picture and what they're used for. Oh, okay, sure. Why not? So we have finished motor gasoline, pretty obvious. It's gasoline. Distillates is your heavier oils, so your diesels. Some of it is used in industrial plants, but if we go back up here to our main information, distillates, 72% are for transportation and 14% are for industrial. Distillate fuel oils are also used for the very little power generation that we have in the in the American side. So some people are burning oil literally to produce power. Small usage, but it happens. Jet fuel, pretty obvious. Petroleum coke is kind of like this heavier soot, if you will. I actually don't really know what it's used for, but I did see that people were burning that for power generation in some of the emerging markets. And in fact, I want to say some of the refineries in the US had started burning petroleum coke because their natural gas price was getting too high. So that's that. Still gas, I have no idea what that is. Hydrocarbon gas liquids is a little bit more of your propanes and butanes, some of the heavier stuff that comes out, even from the oil barrel, even though it's mostly produced from gas. Asphalt and road oil, so that's your paving, your asphalt for your roads. This is an industry that asphalt is something, if you follow EIA data, asphalt will build throughout the year, or throughout the winter, I should say, and then really start building in February, March, April, because they have to consume it in the summer construction season. So watch for these things. Certain things, certain products will build more than others. Residual fuel oil, they just call it resids. That's, again, power generation. Petrochemical feedstocks, that's your feedstocks for creating plastics and other products from petroleum. So a lot of plastics and other clothing and whatnot you'll find, it involves the use of petroleum. Any random product you find, they most likely will have some sort of petroleum component to it, and that's your petrochemical feedstocks. Lubricants would be your drilling fluids, your oil that you put in your vehicle when you do an oil change. Some lubricants are required for industrial machinery, so that's 1%, and then the other products. Yeah, great question, thank you. It says some mass is converted, but volumes will change. Yep. So that's why many nations give details of crude oil in metric tons. Yeah, again, they convert it back to a weight component. It's just easier for some people to understand it that way. Do the refineries buy the oil from the drillers and producers? Yeah, in a way. Not fully. The refiners mostly end up buying oil from the midstream companies. So the Enbridges and the TransCanadas and the whatever the ones in the US are, I don't even know them. And then that's basically it. Yeah, they will decide to pay a certain price depending on global oil markets. And I just laugh about this every time. If a producer wanted to price gouge and they wanted to set the price of their oil at $300 a barrel, it just wouldn't get sold. And they would only have so much storage, so they would fill up the storage, and then they would have to stop producing oil. Price gouging is not as easy as it seems. Like, people seem to think I can just go and sell anything I want at whatever price I want. I would say try it, right? You all probably have vehicles. List your vehicle for $250,000 and try and price gouge people. It's way harder than you think it is. You need so much collaboration between so many people to effectively price gouge that it doesn't even make any sense, along with the fact that it's completely illegal to begin with. So yeah, next time somebody says, people are price gouging, just tell them, so, if it's so easy, why don't you start price gouging? Why don't you start selling stuff at whatever price you want and try and make some money? And people will just shut up because it doesn't make any sense to begin with. Yeah, I love that one. I just love that one. So asking question again, why are you not invested in Oventive? Poor hedging, really. Oventive actually is a really good company. They've got really good assets and they're making tons of cash, but their 2022 hedges are absolute trash. And I just don't like companies with so much US exposure, American land exposure and American production exposure. I like focusing on Canada because I feel like I have an edge in Canadian assets, Canadian acreages, Canadian production. Ovintiv just has too much going on outside of Canada at this point. And I know the decline rates of the shale that they're producing, and just about everything they produce is shale. So if you want to look at one company that's going to get absolutely railed by inflation and inflationary pressures in oil field supply, check out Ovintiv. I think unless they have guaranteed contracts, they're going to get absolutely smoked here. Not saying that that means I should or shouldn't invest in them. I just don't invest in them because it's too much American exposure. And yeah, when I did my Q1 calculations on Ovintiv, I was actually quite impressed by what they put out, especially unhedged. So don't get me wrong here. I don't hate the company or anything like that. It's just not the way, it doesn't fit in my portfolio construction at this time. What is Dawn? I believe Dawn is a hub near Chicago. Yeah, Dawn Gas is near Chicago. So you must have gone and looked at a corporate presentation and somebody mentioning Dawn, or maybe you already knew that, but yeah, it's somewhere near Chicago, I want to say. Yeah, so I'm going to upload this here in PDF form to my website. So check it out. I mean, any questions, let me know. I'm by no means an expert on the downstream and midstream, but I'll find the data that answers your question. I don't care about narratives. I don't care about opinion. I care about data. And if you have a question to me or some sort of narrative you see out there, I'm not going to answer it with my opinion. I'll share data that proves it one way or another. And that way, you know, we don't get caught up in wasting time arguing over things when I can give you the actual data that proves it. Yeah, so I think we're on the hour here, so I'll just take a few more questions here and then end it. I don't really want to get into specific name discussion, but it asks, what is your thesis on Athabasca Minerals? And basically, it's a frac sand company that they bought assets at 10 cents on the dollar. But not only do they have frac sand, they have gravel and aggregates for some of Suncor's mines, which is a stable cash flow business. They're also running all sorts of engineering and new age technology to get better pricing for their product and their contracts. And I've seen this in some other industries, and it's worked out really, really well. So yeah, just at the valuation where they are today, the growth in the top line income, which I'm hoping translates to bottom line EBITDA on a service company. I did want some exposure to the service side. I still don't believe in the drilling companies or the service companies or the frackers or anything like that. But frac sand is one where there kind of was a shortage for a bit. I don't know if there is or there isn't. I don't even really care, because if you can buy mines, sand mines at 10 cents on the dollar, so you can buy $100 million worth of capital for 7 or 8 or 10 million, you already have the asset to begin with. And everything else is kind of just building on growth and market share. So yeah, I don't have a very firm thesis on it. It's a 1% play, and yeah, just some exposure to something that made sense. And I met management when I went to the conference in Vegas, the microcap conference. I met management. I met their CFO. I think I met a couple of the other VPs, and yeah, just had a great chat. And sometimes when you meet people in person, you can really understand who's lying and who's making up stuff and who are legit people looking to grow their business and actively working at it. So yeah, just my opinion, not investment advice by any means. The question, are the regulators throttling crude production? They're not actively throttling production. They're affecting it through volatility and uncertainty. When I'm investing in an oil well today that's going to produce for 20, 30 years, I don't want all this talk about windfall tax and canceling treaties and canceling stuff and changing royalty rates, and you're going to ban me and you're going to do this and do that. That's how they're throttling it, because people are just not confident to invest until you make it clear one way or another it's very hard for people to make decisions on unknowns. But yeah, thank you for that. Do you have any tips on learning more about the oil industry, such as prospecting and drilling? I really don't, unfortunately. The oil industry is one where it's so hard to learn about it. Like there's very few books about how to drill a well. There's very few YouTube videos about how to frack or you know, whatever. So I've never even looked into it, you know, would be my answer. I do think that if you Google PDFs or YouTube, you might be able to find some stuff on how a drilling operation works, how fracking works, etc. And I actually at one point was gonna do a session like this on those things, and maybe I still will, but I'm just so caught up in other things right now. Maybe July, late July or August, I can put one on. But yeah, for now, I honestly, unfortunately, KK, I don't have any tips for you. I would maybe ask the general oil community on Twitter. Maybe somebody has specific literature that they can share with you. Is there any data that shows how high natural gas prices might go? If I had it, I would be a bazillionaire. But I definitely think that as natural gas becomes more globalized, you will see the European pricing and the Asian pricing come back in a way to the North American pricing. As to how high they can go, I don't really have an answer for that, but basically we're low on natural gas, we're low on coal, we're low on nuclear, we're low on oil, we're low on fuel oil, we're low on electricity, we're low on electricity infrastructure and transmission, we're low on energy. This is a growing, like if you look at White Tundra's mission statement, it's a, we're betting on the world's growing thirst for energy, and we don't have the means to provide it, which means there's going to be higher pricing. That's the only way markets balance themselves. And the oil industry is especially interesting because A, I love oil, I've worked in oil, I know oil, but also B, it takes so long to build out energy infrastructure that as an investment thesis, it actually makes a lot of sense. You can't just fire up an oil field randomly. That's not how it works. It takes years of exploration, research, development, planning, drilling, fracking, producing to get energy on production. Hence the structural bullish cycle argument. Yeah, appreciate your comment there, Ayaku and Brock. And yeah, the SPE actually has really good stuff. The Society of Petroleum Engineers has online documents and stuff. Some of it can get very technical, which is why I don't really like to recommend it. You almost need to have a background in oil in some sense, but yeah, check it out. The Society of Petroleum Engineers website is actually really, really good. Has lots of content on there on very deep, detailed stuff as well. Yeah, so Rock, you're asking me the bazillion-dollar question. Any thoughts on the sell-off? I don't really have any thoughts. I think the narrative has kind of taken over here. Also Friday, the report came out that the Libyan oil was producing at 600 or 700,000 as opposed to 100,000. If you look at last week, so not this week, but the week before, when the report came out that Libyan production had crashed to just about zero, that was responsible for a big move in the oil price from like 112 to 120. So if that Libyan production is not really offline, doesn't it make sense that oil would probably fall to 112 again? So I think these day-to-day movements, we maybe think too much about them. We try to analyze them. And a lot of people just try to blame it on random things like COVID or recession or demand destruction. Usually there's an underlying cause that's more accurate. But you know, we're creatures of habit, and we just like to blame it on something where it's hard to refute it one way or another. You know, if you told me oil price fell because of recession fears, can I show you data to prove one way or another? No, likely not. But I think it had more to do with Libyan oil And the reason I started this seminar with a talk about recession was exactly that. I think people are getting fooled by media manipulation on what a recession actually does to oil demand, and where we are today in oil supply, demand, and inventories. A recession may not be enough. You're seeing more and more talk about this. A recession may not be enough to reduce the price of oil below $100 for any constant period of time. And that is my view. And I'll say that I'll record this here is I don't even think a recession can bring the price of oil down below $100 a barrel for, I use 6 months as a number, but for any sort of consistent period, if you will. Again, barring nuclear war or a massive health crisis or anything like that, things change. Okay, there's a giant petrochemical explosion in Shanghai. Yeah, I don't want to get into conspiracy theories. I don't really have any insight into what's going on. But when you run things hard, when you run equipment at 100%, 95%, things go wrong. The way people engineer things is to run at a specific amount of what do you want to call it, like a feedstock percentage, and then you need regular maintenance. During COVID, people skipped maintenance. They just left them be. They didn't spend enough money, enough time on it, and now we're kind of paying the price for it with these higher and higher issues and manufacturing and industrial accidents. Are you still planning on doing a presentation on different types of hedging? Not really. I don't think it's a topic that really warrants its own thing. I might jam it into a different presentation. Again, for those who joined late, tomorrow, 11 o'clock Mountain Time, I'm going to share all the free sources of data that I use to track oil supply demand. I use a lot of paid data as well, but I mean, people probably don't want to be signing up for stuff. So I'll share all the free data that I look at, how I analyze it, and just people who want a little more conviction in the trade. They don't believe or they don't necessarily want to rely on me to keep updating them all the time. You want your own data sources. I will do that tomorrow. So maybe I'll throw this in there, Rock, about the different types of hedging, but it all kind of depends how much time I have here later today to get that done. Yeah, and I guess people are maybe looking for a pep talk from this presentation. So I will say this, that the oil market has always been volatile, and for people who wonder why the COM gets so much hate, why people hate oil, they hate oil investors, etc., or people have so much PTSD, they can't see the free cash flow in front of their screen. Why are people not buying these oil stocks that I'm recommending, within your friends and family? It's because oil is volatile. I cannot understate it. I just cannot. Oil is an industry that takes a mental toll on people. Investing in oil is not for the people who lack conviction, who don't understand what they're buying. This is not an industry for the renters, for the tourist, for people who just want to, buy and try and day trade it. Oh, you will get absolutely killed trying to day trade oil, like absolutely destroyed. People think it's an easy industry to try and time the markets and try and figure out what's going on. There's a reason natural gas trading is known as a widow maker. There's a reason for these things. Do not take them lightly. And I hate to be doom and gloomy on this, but have a look at your mental fortitude, your mental strength, look at your portfolio construction, look at your risk tolerance, and do your due diligence. If there's one industry where this is important, it's the oil and the mining sector. I don't do mining, so I'll say it's the oil sector. It can move violently. It can move for no reason. Things can trade at much higher free cash flow yields than you might think they can. The money flows are just weird. The volumes are getting lower in terms of the open contracts in the barrels of oil currently people are trading. That inherently increases volatility both ways. the broad market is absolutely getting railed. And when the broad markets, when things like that happen, it's up to you to determine, is energy going to survive within it? Is energy going to thrive, or are they just going to sell everything? And there's no one answer. It all depends on certain things. I would say 2 weeks ago, energy was thriving in the face of a broad market collapse. Last week, it was maybe not doing so well. So, if your investment thesis is long term, is 2, 3, 5 years, I think we need to zoom out a bit. But if you're trying to trade oil, I'm not going to say do it or not do it. It's not what I do. I don't try and time my buys and my sells, even though you might think, oh, if I would have sold last Wednesday and then bought this Friday, I could have made so much money. It's easy to say that in hindsight. We never see it coming, neither the downs or the ups. I keep coming back to this point. Crescent Point went up like 30 trading days in a row in December and January. People sold throughout that run thinking they could buy back lower. They never got the opportunity. So don't kid yourself. As much as you think, it's easy to trade oil and oil equities, it gets even harder because sometimes the price of oil will be up and the equities will fall, or the price of oil will be down and the equities go up. There's just so much going on that I invest in strong companies with good assets, good acreages, solid financial leverage that I'm comfortable with, and I just leave them. I put in the work on the upfront part of it as opposed to trying to time it. But again, that's just my portfolio, the way I do it. Yeah. So yeah, I want to end it here. I'm gonna put the replay on here on the website and YouTube, probably in a couple of hours here. It'll be on there. The slides will also be uploaded to the website. I haven't posted the link to tomorrow's seminar, but it's going to be the exact same link as this. So as the link you used to join today will be the exact same link for tomorrow's. And I hope to see people there who are maybe a little bit more interested in the exact data aggregation and where they are on supply demand inventories. So I look forward to that. Also have a couple Twitter spaces coming up this week or next week, I should say. And then, yeah, we'll continue on with the valuation sessions and continue with that. I still want to do some deep dives on some of the junior names and share information on them. Possibly kind of mid-July is what I'm targeting, and always open to other ideas. So if there's something that I can share from my background in oil or oil investing, I'm happy to put it on the list and kind of share sessions like this and try and get rid of energy ignorance, because if we keep energy ignorance for too much longer, it's going to have a very detrimental effect on society in general. So yeah, we'll do what we can, and always appreciate everyone joining in. Appreciate your support, all the questions, all the participation, and yeah, we'll catch you at the next one. Thanks again.